Financial markets just ripped higher on new trade deals, but are investors flying too close to the sun? Under the surface, major risks are rising. From U.S. record highs to China's trade gamble and Europe's fragile momentum, everything's shifting fast. This week's moves set the stage, but next week, it's loaded. GDP, Fed, jobs, China tariffs. You can't afford to miss what's coming. Welcome to Weekly Market Update, where two generative AIs, guided by a former senior portfolio manager, deliver the sharpest, fastest global market intelligence out there. We decode what matters, so you stay ahead. If you're just watching headlines, you're already behind. Listen now, and don't be the last to know.
This past week, well, it delivered some really significant shifts, particularly on the trade front. Left a lot of us with questions, right? So, our mission today: unpack the critical movements, the key data, the underlying forces, so you, our listener, are truly well-informed. And joining me, as always, our brilliant strategist, ready to connect those dots and give us that crucial so what insight. Okay, let's dive into this incredible week.
Yeah, definitely a lot to unpack this week. Plenty of nuances, lots of signals to read.
Absolutely. So let's kick off with the global market recap. Big picture. Markets climbed pretty much across the board. You could really feel that sense of relief as new trade agreements eased those tariff anxieties ahead of the August 1st deadline, pushed both the S&P 500 and the NASDAQ to fresh record highs.
It's really striking how quickly markets jumped on that positive trade news. It just highlights, the market's hunger for certainty right now, especially when you look at the backdrop. I mean, we've got some diverse, sometimes conflicting economic signals floating around. Shows you the power of a narrative, doesn't it?
Totally. And speaking of records, here in the U.S., another week, another record for equities, it seems. The S&P 500 climbed, 1.46%, NASDAQ up 1.02%, Dow Jones followed suit up 1.26%. So beyond that general trade optimism, what were the key engines here?
Well, yeah, the primary drivers were, like you said, those improving trade dynamics. That was huge, but also some pretty solid earnings, especially from the tech sector. On trade, you had the U.S. sealing new deals with Japan, Indonesia, the Philippines, and importantly, making real headway with the EU talks, too. All that started to lift the cloud of those looming tariffs.
Right. And on earnings, any big winners or losers that caught your eye?
Oh, definitely. Alphabet, for instance, shares jumped 4.4%. They had really upbeat commentary about their AI progress. It really taps into the current excitement around AI potential. On the flip side, Tesla pulled back 4.1%. They missed earnings expectations. Just a reminder that even the market darlings can, stumble sometimes.
Now, looking at the broader U.S. economy, we're getting, like you said, kind of mixed signals. July's flash PMI, that's the Purchasing Managers Index, folks, a good gauge of economic health. It showed really strong services growth, 55.2, right? But you mentioned conflicting signals. Where are those showing up?
Exactly. If you connect this to the bigger picture, there's this interesting divergence in the macro data. Services expanding nicely, but manufacturing, renewed weakness. The PMI actually dipped below 50 to 49.5. That signals contraction. So this divergence, it raises a pretty important question. Can services really carry the economic momentum all on their own? Or is manufacturing weakness going to eventually, drag things down?
That is the critical question, isn't it? When you see that kind of split historically, what usually tells us which way the economy is really heading? Is there a tipping point?
That's the million-dollar question, right?
Yeah.
What's often insightful is that while services can lead for a while, persistent weakness in really foundational sectors like manufacturing and, as you'll mention, housing can be those early warnings, signs of a broader cooling, especially if consumer spending can't quite bridge that gap. We've seen times where, say, tech enthusiasm masked deeper issues. We need to watch closely to see if this time is genuinely different. And yeah, housing, that's another area flashing some warning signs.
Precisely. Adding to those potential cracks, we saw some real pain in housing. Existing home sales fell 2.7% in June. That's a direct hit from those high mortgage rates, record prices. Makes affordability a huge hurdle. What's the bond market doing amidst all this?
Interesting moves there, too. Long-term treasury yields actually fell. And investment-grade credit, that's your higher-rated corporate bonds, they outperformed pretty notably. New issues saw really strong demand. The bank loan market even had, get this, its fourth busiest new issue day ever. So that implies, a pretty significant appetite from investors for yield, even if it's in relatively stable areas. Capital is still looking for a home, but maybe with a bit more focus on quality.
Okay. So the big picture for the U.S. market, lots of celebration over trade deals, AI optimism in tech, definitely.
Yeah.
But Those manufacturing soft spots, the housing headwinds, those are important cracks you, our listener, should definitely keep an eye on. Bit of a tale of two economies, maybe. Now let's shift gears, head across the Atlantic. Europe. Markets there show some resilience despite, well, some headwinds of their own. The Zesto XX 600, the pan-European index, was up about 0.5%, near 0.54%. Germany's DAX was down slightly, around 0.30%, but France's CAC 40 was up, and the UK's FTSE 100 had a solid week, up 1.43%. What's the ECB, the central bank, up to?
Well, the big news there was the European Central Bank's decision. They held rates steady at 2%. Now, that comes after 8 straight cuts, so it's a very clear signal they're pausing the easing cycle. And President Lagarde's tone, a little more hawkish, meaning, leaning towards tighter policy or at least no more cuts soon than maybe some expected. That actually gave the euro a bit of a lift. This wait-and-see approach from the ECB, it provides a measure of stability, gives the economy time to digest things.
Right, a pause to take stock, and the broader economic pulse in the Eurozone. What are the PMIs telling us?
Well, business activity, the Eurozone PMI, it edged up slightly, just over 50, at 51.0, so slight expansion. But it was a mixed bag underneath. Germany seemed to gain a bit of confidence, but France actually softened a little. And over the UK, retail sales bounced back a bit, up 0.9% month on month, but that actually missed forecasts. So consumers aren't exactly roaring back. Plus, their PMIs showed services strength fading and more slack appearing in the labor market. Still some challenges there.
Okay, so the key takeaway for Europe: relief from the ECB stability, relief from trade tensions easing, but that underlying economic momentum still looks pretty fragile, a delicate balance.
Absolutely. Stability is welcome, but it's not exactly a green light for strong growth yet.
Okay, let's pivot to Asia now. Japan, wow, delivered a really significant rally this week. Both the Nikkei 225 and the Toppi, Japan's main stock indices, surged 4.1%. That's a big move. What was behind that?
Yeah, that surge was largely down to a major trade win for Japan. Remember those threatened U.S. tariffs? Well, they agreed on a 15% cap for most exports, including really critical sectors like autos. That was seen as a huge victory compared to the 25% threat hanging over them. Big relief for key industries. But it does raise the question, how much of this rally is sustainable without bigger, broader structural changes in Japan's economy?
That's a fair point. Beyond trade, any internal stuff happening in Japan? I remember some political noise.
Indeed. Adding a layer of complexity, you've got some political jitters. Prime Minister Ishiba, well, there was speculation he might resign after his coalition lost ground in the upper house election. He's staying firm, for now at least. But that kind of political uncertainty can sometimes dampen market spirits. Now, on the Bank of Japan watch, Tokyo's inflation, the CPI, came in at 2.9%. That was actually below forecast. Still, expectations for another budget rate hike this year, they're still very much alive. The market seems to think inflation pressures could rebuild. We also saw that economic divergence again. Services PMI held firm, but manufacturing slumped because of that earlier trade uncertainty, though that part will likely bounce back now post-deal.
Got it. So for Japan, the vital insight seems to be trade breakthrough. Big short-term tailwind, yes. But keep an eye on political stability and those inflation dynamics. They could definitely complicate the longer-term picture. Mixed bag beyond the immediate cheer. All right, let's wrap up our world tour in China. Markets there gained too, mainly on hopes of maybe a decisive round of U.S.-China trade talks. CSI 300 up 1.69%, Shanghai Composite 1.67%. Hang Seng in Hong Kong saw a solid 2.27% gain. What's the feeling there?
Yeah, the diplomatic hopes are really pinned on these Stockholm meetings happening this week. The goal is to extend that tariff truce, the one set to expire in August. You probably remember that 145% tariff scare back in April. That's still fresh in people's minds. So just the idea of a thaw in relations, it really buoyed sentiment. Shows you how sensitive things are to geopolitical signals. If you connect this to the bigger picture, any progress here is just massive for global stability, for trade flows.
Absolutely. And what are investors looking for next from Beijing itself? Any domestic focus?
Well, beyond the trade talks, investors are really waiting for clearer signs of stimulus from Beijing. Expectations are still, I'd say, pretty modest ahead of the upcoming PMI data, but they're looking for some concrete action to support the domestic economy.
Okay, so the core message for China: markets are hopeful for stability, hopeful for a trade deal extension. But the real lasting relief, that really hinges on a concrete, positive outcome from this week's summit in Stockholm. Cautious optimism is maybe the phrase. That was an incredible tour around the globe. Phew. So what does all this mean for the week ahead? Get your calendars ready, everyone, because it is absolutely packed. Lots of critical data points coming our way. Okay, starting in the United States, Wednesday, July 30th. Q2 GDP, the advance estimate. Big question. Can the economy bounce back from that 0.5% contraction in Q1? Also Wednesday. The Fed rate decision and the press conference. Rates almost certainly on hold, right? But that forward guidance, what's the signal about the future? That'll be absolutely key. Then Thursday, July 31st. Core PCE price index and personal income for June. That's the Fed's preferred inflation gauge. Everyone watches that like a hawk. Any signs of sticky prices? And Friday, August 1st, non-farm payrolls for July after June's surprise 147,000 gain. What's the follow-up? Also Friday, ISM manufacturing PMI. Will factories finally reflect that tariff relief or show ongoing pressure? Lots to watch there. Okay, shifting to Europe. Wednesday, July 30th. Q2 GDP flash estimates from Germany, France, Italy, the whole Eurozone. That gives us the growth picture. Thursday, July 31st. Preliminary inflation for July. Super important for the ECB's next move, especially after they just hit pause. And Friday, August 1st, the Eurozone flash CPI. Again, watching for sticky inflation that might nudge the ECB off that wait-and-see stance. And finally, quick hits for Japan and China. Thursday, July 31st, Japan, IJ rate decision and consumer confidence. Key reads on policy and domestic mood. China also Thursday, 31st, the official NBS manufacturing PMI for July. And then Friday, August 1st, the Caixin manufacturing PMI. Both giving vital clues on China's industrial health and how trade talk sentiment is playing out on the ground. So, boiling it down, the absolute highlights to watch this week. U.S. GDP and jobs. Is Q2 a real rebound? How tight is that labor market really? The Fed's stance, obviously. Pause is expected, but will Powell lean dovish or hawkish? What's the signal for later? Eurozone growth and inflation data that'll shape the ECB's next few months. Japan's BOGA, what's their tone now, post-trade deal, any policy shift hints, and maybe overarching everything, China tariffs. Can Stockholm actually deliver a longer-lasting U.S.-China détente? Or are we going to see more uncertainty creep back in? That could ripple everywhere.
Right. So given everything we've just unpacked, let's try and distill this. What are the top 5 key risks you, our listeners, should really be monitoring as we head into this absolutely crucial week? These are the things that could really shift the story.
Certainly. Okay, first up, U.S. manufacturing and housing weakness. Despite the market optimism, those strong services, that divergence we talked about, weakness in these foundational sectors, manufacturing and housing, it could signal underlying fragility, something the headline numbers might be masking. If that slump continues, it could eventually pull down the broader recovery. That's risk number 1. Second, the Eurozone's fragile momentum. Yeah, the ECB held steady, provided some calm, but the economic data, still pretty mixed. So sustained recovery isn't guaranteed. Any negative surprises in the upcoming GDP or inflation data could quickly rattle investors who are maybe feeling a bit too comfortable with that stability right now.
Third risk, Japan's political and inflationary dynamics. That trade win was big, fueled a rally, absolutely. But ongoing political instability, especially if PM Ishiba's position weakens, plus those persistent inflation worries, they could really complicate Japan's longer-term outlook, maybe create headwinds for needed reforms down the line. Fourth, the uncertainty from U.S.-China trade talks. Okay, sentiment is definitely up because of the Stockholm summit hopes.
But real lasting relief for Chinese markets and, frankly, global markets that depend on that trade, it hinges completely on a concrete positive outcome. That tariff scare from April, still a very recent memory. Any feeling of no progress could see sentiment reverse pretty quickly. And fifth, maybe the most encompassing risk right now, economic reality versus investor optimism. Look, the market rally has been strong, reacting well to trade news, to earnings, undeniable. But this week is just jammed with crucial data, GDP, inflation, central banks. The rally faces a real gauntlet of tests. Can the actual economic reality keep pace with all that investor enthusiasm? Or is there a disconnect forming? A disconnect that might lead to a reevaluation of where things stand, current valuations. That's the big theme for the week.
So, wrapping it all up, what does this mean for you? Markets are riding high, no doubt, fueled by trade breakthroughs, tech tailwinds. But as we've just laid out, this upcoming week is absolutely critical. It could validate that optimism or maybe expose some of those underlying fragilities we've been talking about.
Exactly. And knowledge is most valuable when you understand it and can apply it, right? So as you go through your week, maybe think about how these interconnected global events, every data point, every central bank comment, every trade whisper could influence things, whether it's your own financial thinking or just your broader understanding of the economy. It all fits together.
So the big question to ponder, will this period of investor optimism keep defying some of those underlying economic cracks we've identified? Or are we actually on the cusp of a reevaluation, something that could reshape expectations? Definitely something to think about as you navigate the week ahead. We'll be right back here to unpack it all for you next time on The Deep Dive. Until then, stay informed and stay curious.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.